So the state of the market is our annual look ahead at the future of the retail fund industry. We look 5 years ahead and we forecast assets and flows across product types, across vehicle types, across asset classes. And the idea is to guide asset managers and help them make strategic decisions um, that are going to guide their future in the next half decade and beyond. But the biggest challenges facing our industry is that of more moderate growth. Over the past 5 years, US equities have dominated everything. So if you have a lot of US equity funds in your stable, you've been pretty good. There hasn't been a lot of growth outside it. But most assets in the industry are invested in US stocks. And most market forecasters expect something different over the next 5 years, more modest growth. And that will put asset managers under pressure. The revenues obviously come from the assets that they manage. And so slower growth means weaker revenue growth. So that's one challenge. A second challenge is the ongoing move from active to passive investments. This has been going on for a long time. We started off the decade with something like 60% of all assets in active funds. At the end of the decade, we see it being closer to 40%. So another great challenge for active managers. There is some good news, though. There are many more opportunities or many places to play. Um, some doors close, other doors open. And one open door is a broader, more balanced set of growth opportunities. I mentioned earlier that U.S. equities have been very dominant over the past 5 or 10 years. That's come at the expense of other asset classes. International equities, fixed income, for instance, didn't have a great uh, half decade. They underperformed. Well, most market forecasts expect a different dynamic where those asset classes perform better. So, for managers that have a specialization in fixed income or international or have broad portfolios, there's an opportunity to grow in new ways. Secondly, I'd point out there's a proliferation of new product types coming out. Is active ETFs for one, but there are also a whole other host of ways to deploy your capabilities. It might be separately managed accounts. It might be some kind of customized solution. There are CITs. That there's a line from Jaws, the most famous line, we're going to need a bigger boat. Well, I think for our industry, we're going to need a bigger product shelf given the proliferation of product out there. We're seeing a mix of new and old patterns. In previous reports, we discussed at length the proliferation of active ETFs. Well, that is actually accelerating. This year, we've seen record active ETF launches, more than 500 so far this year. There's something like 1,500 of them in registration with the SEC, 1,500. So there's this giant product queue in development. But it's not just active ETFs. We're seeing new kinds of active ETFs. Most of them you would recognize as traditional active strategies that are pursuing alpha in conventional ways, but we're also seeing other kinds of product. Some are focused on delivering solutions to investors. These might be like buffer funds. These are funds that protect investors on the downside. We're also seeing active ETFs that provide exposure to various asset classes or product types. It might be crypto. It might be leveraged exposure to an individual stock. And these kinds of products are not necessarily for everyone, not for every asset manager, not for every investor type. But what they are is they're illustrations to asset managers that there are new ways to reach new audiences that ETF vehicle makes possible. And last, I would note, it's not as big of a trend, but I think it's one worth keeping an eye on, is we're seeing the proliferation of semi-liquid vehicles like interval funds or tender offer funds. And I'd keep an eye on this space because some of the biggest players, such as Capital Group and Vanguard, have or will enter the space soon. And both of them are pretty conservative, long-term oriented product developers. And so I think if you see firms like that jumping on, this is a trend that has real long-term legs, and it aligns with a broader trend um, towards investors' embrace of alternative or private type investments. Well, advisors obviously have a big influence on what gets sold. They are driving the ETF wave, um, and especially the active ETF wave. We survey advisors every year and ask them what's their vehicle of choice if they could choose between a mutual fund, an ETF, or an SMA. If their favorite manager is available on all platforms, all else being equal, what would you choose? 60% of advisors tell us they pick the ETFs. Now, one problem that we've had in recent years is many advisors' favorite managers haven't necessarily been available in the ETF format. However, we've seen this proliferation of new product. We see this long queue of new product waiting in the wings. And so it's becoming increasingly likely that advisors will be able to find what they're looking for in the ETF vehicle. So when they're given the choice, we think it's likely that they're going to take it. And so what does that mean for asset managers? Well, it means that asset managers need to develop very close relationships with advisors. Advisors are increasingly busy. They have very little time actually to do a lot of the legwork on the investment research or investment selection piece of their responsibilities. And so asset managers can be very helpful in helping manager or advisors grow their businesses, and help them find new clients, educate them on new solutions, help them deliver messages to their clients, especially given that we are seeing this proliferation of new product types, new asset classes. There's a real need for education, not just educating the end investor, but also empowering the advisor by helping them understand what are going to be the most important drivers of returns over the next 5 years. Well, a few things are driving the private markets trend. One is just the economy and the shape of our markets have changed. Increasingly, more economic activity happens outside of the public markets. So that's one reason. Two, you see an increasing need for diversification. We saw in 2022, when stocks and bonds both fell at the same time, that there was a need for another tool in the toolkit or more tools in the toolkit in order to protect investors' portfolios. And alternatives are seen as kind of one additional tool to protect investors and their portfolios. So those are the two main reasons. And I think third is regulation. We see a much more friendly regulatory environment in Washington, D.C. Recently, President Trump signed an executive order that would allow managers to potentially offer private investments in 401k plans, for example. Also, cryptocurrencies could be held in the same format. So you have you have kind of an alignment of stars here in favor of private markets. So what does this mean for traditional managers? Well, one, I think they need to decide whether they want to enter this space or not. And there's several things I think they need to think about. One, this is a new asset class to a lot of advisors. And so this to enter the space, it requires a huge investment in resources and education. Second, it's a huge investment, or at least a very large investment in your sales capabilities. Most clients we talk to, tell us they get specialist type wholesalers to help advisors and their clients understand these products. So it's an investment there. And I think you also need to think about whether you can offer a differentiated product in this space because it is kind of unfamiliar, untested to a lot of fund buyers. There's going to be this gravitation, and we've seen it already, to either well-known alternative specialists, the KKRs of the world, the Carlyles of the world, firms that people know, and very large traditional asset managers. And so, that could leave smaller, more mid-sized generalist managers um, struggling to enter the space. And so I think it's not the only opportunity set out there. In fact, you might find it a diversion if you think you have stronger capabilities elsewhere. If you think you're a stronger fixed income investor, then, maybe you need to, let's say, limit your exposure to private markets or focus only on the areas where you think you're capable. I think the most successful managers will have adapted to a market where you can't rely on markets alone to fuel asset growth. They will need to have met the product and distribution challenges of our era. And so I think though there is no one path to success, I think that's the good news. I think there are many ways to get there. You might be a large scale player, and you'll try to maintain your advantage in low fee investments and use that to fund growth initiatives elsewhere, whether in private markets, alternatives, creating tools to help investors build whole portfolios, or you might take a more focused route. You're going to specialize on, where you think your capabilities are strongest, where you think your distribution capabilities are strongest. So there's no one path to success. I would say the most successful managers are going to make, critical strategic choices. You really can't afford to be in the messy middle. On one hand, I think you'll have very large, diversified firms that have lots of scale, and they can use that scale to keep fees low, to develop new portfolio solutions, to grow their alternatives shelf. And on the other end, I think you're going to see some real specialists that create unique solutions that meet the needs of investor portfolios. So if you do not choose one path or the other, I think the risk is that you end up in a mushy middle and without the strength of the market propelling you forward, an advantage that many managers have had over the past 5, 10, 15 years. I think they could see some serious trouble.